Today we will discuss how an investment portfolio should look like, especially for retirement provision. Because we see many contracts of our clients, contracts that they applied for in the past, where the clients have real big disadvantages. Maybe the product itself is good, and maybe also the provider is good. And even the way of investing in a tax optimized way is a good idea, but the investment core doesn't look well, which would result in a really low interest rate. So you would end up having low retirement money. And this is something we should avoid. So let me explain how your investment portfolio for retirement should look like. So first of all, you can obviously decide if you take the so-called basis provision or if you take the flex provision. Okay? So here it obviously depends if you prefer tax optimization until retirement or if you prefer, let's say, lump sum option in retirement. But anyway, it should be tax optimized, and your retirement investment should also be done in Germany. So what you should avoid is, first of all, having a so-called guarantee included. Even if it sounds really well, you will end up having an interest rate of maximum 3 to 4%. Then you have a guarantee that you won't have enough money in your retirement. So this actually doesn't make sense. So any solutions like Riester, in your case especially as an expat, and company pension won't make sense. If you say, I would like to have the guarantee and I'm willing to lose some interest rate, and it's just a mix of a solution where you have a guarantee and where you are fully invested so you can sleep well, okay, this is fine. Okay? Second thing you should avoid would be investing into bonds or multi-asset funds, because also here the interest rate is not high enough. So this is also something you should avoid. What you should also avoid would be saving money in single stocks, because too much work actually, and long term the solution is typically stronger. And what you should also try to avoid are actually mutual funds or any stock mutual funds. So why? Guarantee interest rate too low, bonds, multi-asset fund, interest rate too low, single stocks, risk too high and too time consuming. Especially in the end, if you turn 55, 60, managing all your stock portfolio for retirement yourself, I would not recommend that if you're not a professional. And stock mutual fund, the costs of the actively managed fund are too high. So the solution would be an ETF investment. Because typically for ETFs, you just have 0.2% management costs of this ETF. Typically, a stock mutual fund is significantly higher because it's actively managed and the fund manager would like to earn some money. So I would only recommend ETFs for long-term investments. We can look at many different tests and case studies and so on. But in 95% of the cases, the ETF investment is stronger, especially if we talk about 20, 30 years. Typically, the market is stronger than any human being, okay? On average, let's say. Therefore, I would recommend an ETF investment. So the question is, how should your ETF portfolio look like? I would recommend something between 3 to 4 ETFs to diversify properly. And now the question, how should your investment core should actually look like? So let's say you have The classy one, MSCI World, or any comparable world ETF, which is investing globally. Disadvantage of these world ETFs are they have a big proportion invested in the US market. To avoid having a cluster risk, we don't just take the MSCI World, we also add some other ETFs on top. Please keep in mind, typically 60% is US. And if you invest 60% in one country or in one currency or in one sector or one industry, it's definitely too much because you rely too much on some specific conditions. Second would be any emerging markets ETF, where you have more fluctuation, but long term, definitely bigger profit expectations. Okay, so countries like India, Brazil, South Africa, Mexico, where you have huge growth rates, but also some other issues, either politically, socially, and might be in the future also economically. So we will see. It's not that stable. So what we also add to have more stability would be, for example, any Europe ETF, let's say just 15%, just to have some steady profits. And then if you like, you could also add some sector or industry ETF where you expect growth, where we expect also big growth rates. So for example, any automation ETF where you invest, for example, in AI companies, especially. Okay, so what you now can do, just as an example, for example, would be that you have 15% here, that you have 15% here, then you have, let's say, 20% here. So you have 20, 30, 50, and 50% here. Okay? What's also possible is if you have 25% here and then you have 45% here. It depends on many different factors where our decision in the end ends. Okay? So this is really important because now you have good diversification, which is also rule one in investments. Second, if we invest in ETFs, we invest long term. Otherwise, we also might suffer on the fluctuation. Since you save money for your retirement, all good. Now you would like to have high profits. Yeah, definitely. Expectation would be something between 7 to 9%, plus minus 1. Depends on how the markets are developing over the future. So you have on average 7 to 9% fluctuation. You don't have any big drawdowns because you are diversified properly. So it's not either plus 25% or minus 25%. So this is solved, and we have pretty low management costs. So you also receive most of the interest because only 0.2%, for example, for the ETF costs are deducted. So now this is how I would set up your retirement investment strategy, at least. If you would like to invest more, which is not necessarily for retirement, I would do it differently. So for example, if you have a time horizon, or let's do it here. If you have a time horizon of 10 years, for example, I wouldn't only invest into ETFs because then it might make sense to have some active management behind. But I would definitely also include some ETFs in that portfolio. So as you can see, it totally depends on your financial goals, and specifically it depends on your time horizon. So if you would like to have help checking your current pension plan, or you are interested in investing money for your retirement, visit our website, register for a free initial consultation, and we will see what would be the best solution in your case. Talk to you soon and take care.